So recent market volatility have many retirees and pre-retirees a little jittery, and some are seeking safety. Now, volatility is normal. It can be worse for retirees, though, taking income. My guest is Bo Caldwell in Portland, Oregon. So, Bo, it has been said that market losses and corrections are far worse for retirees. Why is that the case?
Well, that's a really good question, Scott. I mean, the biggest thing I think that drives corrections and market volatility being a bad thing for retirees is they're taking money at that point, right? So when you're thinking about retirement and retirement planning, most people think about putting money away in their 401k or putting money away in their IRA, and so they're constantly saving money. And you probably aren't going to touch it for 5 or 10 years, and so you have time for that market volatility to ride itself out. But if you're pulling money out and the market takes a dip, then you're actually pulling extra money out. And the biggest thing is a lot of people don't understand, if you lose 20% in your portfolio, you actually have to get 25% in a return to get it back. So if you're already drawing money, we take that 20% downturn and now we're taking another 5% out, you're down 25. And it's that much harder to get back, especially if you don't have time to wait for the market to turn itself around.
So in planning for retirement, of course, managing risk is crucial. How do you know if you're taking too much risk?
You know, it's really hard to know if you're taking too much risk without doing some form of a risk tolerance questionnaire or doing some form of a testing. When I sit down with clients, we ask them a lot of questions that are not just monetary, but also feelings-wise. And a big thing is, if you had what happened in 2008 happen again, if we have another financial crisis, and if I can show you what your portfolio would have done in that situation, and you say, well, that's something I can't stand, then you're taking too much risk.
Bo, normally the safe money portion of a portfolio is something in bonds or CDs, but these aren't returning much these days. What are some of the alternatives?
You know, that's a good question. A lot of times people traditionally went to those bonds because they were safe money and they had a good return. And in fact, a lot of people don't understand that over the last 20 years or so, bonds have been declining in interest rates, and so their price has gone up. So people have seen a real return that's a lot higher than they expected as well. And anymore, even on money market, you can't get anything. So there are other products out there with my clients. We like to look into different insurance-based products primarily, because that's a good way to get that bond-like return with the guarantee of not losing any money. And sometimes you sacrifice some upside, but at least we're keeping that downside protection.
Once again, that's Bo Caldwell in Portland, Oregon. This is Retirement News Online.